So let's start with the panelists. First, we have Euan Rellie, who co-founded Business Development Asia, a cross-border investment firm based in New York and focused on Asia. Next, we have Rene-Pierre Azria, the CEO of M&A advisory firm Tegris, LLC. He has closed approximately $100 billion of domestic and cross-border transactions. Robert Colorina is the director with AIAC Group, an equity firm of manufacturing and technology companies in 20 countries. Brenen Hofstadter is president of GCM. He has 20 years of experience selling companies across the US and Canada. Federico Mennella is managing director of Lincoln International, where he advises corporate and private equity clients. This is a tricky name. Kenneth Gerasimovich, is that close enough? Okay.
Close enough.
Is a shareholder of law firm Greenberg, Traurig, and he advises multinational corporations on deals, proxy contests, and other matters. So let's get this kicked off. This has been a very big year for deal making. Year-to-date, global M&A has hit the $3 trillion mark, and that's up 31% over the same time last year, the highest amount since 2007. Cross-border deal making has been a huge component of that. U.S. companies have announced $211 billion in deals with foreign targets, and even more staggering, the volume of foreign companies striking deals in the U.S. increased 200% to the largest number on record since 2000. So we'll start with the softball. What do you all think is driving all of this cross-border activity, especially the investment into the U.S.?
Well, thank you for having me, and thank you for the introduction. I think cheap capital is the prime determinant among both Asian buyers that we see and Western buyers, combined with a very stable GDP growth in both continents.
Thank you, Euan. I think that I agree. I would emphasize growth as the differential between Europe or European boards and the US. And the second point I would emphasize is deflation, and the fact that in a deflationary period, cutting costs has to come from mergers.
I would suggest one different angle, which is a movement towards safety. Despite some of the rumblings in Washington and budget, I think with respect to both fixed income treasuries and then also to have the growth opportunities that you see within the tech community here in the U.S. Is a dual plus.
Yeah, I would add that in marketing our private clients, we're always looking for strategic buyers that are trying to fill in their own gap. And so in the case studies I present in a bit, we'll talk about how U.S. companies provide really unique opportunities for foreign buyers to leverage more access to resources, capital, and technology.
Inbound M&A is also attached a little bit to the perception that there is a lot more opportunity in both synergistics for the strategics and private equity guys in Europe are now moving here. We are noticing a number of private equity firms that were European opening an office here and trying to make investment. Family offices that used to just be in Europe are now coming in.
Yeah, I mean, being at the end and hearing all the other answers, I have to agree with everyone, but I think to summarize is there's a lot of safety in investing in the U.S. The U.S. economy is doing pretty well compared to a lot of other places, and combine that with the cheap money, combined with the fact that it is always safest to invest in the U.S. Our economy is just, no matter what anybody says, is still a dynamic place to invest. And candidly, it's really easy to invest in the U.S. There's just not a lot of obstacles to investment in the United States. There's foreign ownership rules just barely existing in certain industries. So it's all of it together, I think, makes inbound M&A a really good bet for people.
Are there certain sectors that you're seeing foreign buyers focus on in the U.S.?
I'm not sure, candidly, if there are certain sectors. I was just floored by the real estate deal that was just done when a Chinese company purchased the Waldorf Astoria for over $1 billion. So I think real estate is huge. It's one area that you are seeing a lot of. And I think, interestingly enough, in New York especially, you just see even apartments are being purchased by a lot of as foreign investment for folks. Just the price of markets just skyrocketing because of foreign owners. So I think as an indication, real estate is a big area for foreign investment. But I'm sure there's lots of others.
Right. So one of the biggest cross-border stories of the year, a topic that I've spent a lot of ink on at the Wall Street Journal, is conversion deals. They've driven a ton of volume, but they've been called, unpatriotic by Washington. Treasury Department's clamped down on them. Love to get all of your views on how the Treasury Department's handled conversion deals and if their response will sort of hamper future M&A.
Maybe I'll take the first crack at it. It's funny that the department, that the Treasury should wake up this year. I mean, they've been going on for years and years. I remember when Tyco went to Bermuda. When was it? The 90s, mid-90s? It's been around. And it has to do with logic of cutting costs, right, wherever it is. So it's the tax time now because productivity is hard to achieve somewhere else. Funny enough, it has also woken the European authorities as to tax structuring among large multinationals. And I think what this says as a whole, as a general concept, is that in the next few years there will be a complete restructuring of the way multinational corporations are taxed, both here and there. I think taking it out of context is sort of a challenge.
Maybe comment a little bit there. I mean, we're principal investors, as mentioned, in roughly 19 countries and roughly 20 states domestically. And I guess Deputy Mayor Steele, who was second in command to Mayor Greenberg, had an interesting analogy that 50 states in the U.S. compete against each other very aggressively with tax basis things and what have you. No one makes it's fair business, and I think this topic of cross-border globalization. A number of the shareholders of the listed companies are going to be, frankly, domestic and international shareholders, institutional shareholders. So at the end of the day, if a company's board and a company's management team sees an opportunity, and if part of that cost of capital is better to look at this type of structure, it's, at the end of the day, ways in which to make the business more competitive so that they can therefore invest in the capital expenditures, research and development, those type of things.
I think that's right. I think capital finds a way to get to the best location. And it's probably a mistake for the US government to try and regulate people to stay here. Money will move overseas, and what the US government should be doing is fixing the tax policies in this country.
I was going to say that you want to stop inversions, lower taxes in the U.S. to make it more competitive worldwide. The U.S. tries to compete worldwide in a lot of areas. I mean, the SEC long ago recognized our public offerings and public filings need to take into account international companies coming here. So why can't the tax policy follow suit? We compete in the world. So lower taxes, fix. I'm not saying that you should. You can do it tax neutral. I mean, because there are certain industries that get specific breaks. For example, take away the specific corporate welfare, if you want to call it that. Just lower taxes across the board. You'll get rid of inversions.
So one of the common complaints I hear from bankers is how hard it is to do deals with foreign buyers who might not know, the formal nature of them. So what are some of the cultural issues you navigate on a daily basis when you're doing deals cross-border?
We see lots of foreign buyers. We see Chinese buyers who haven't bought overseas much before, who are desperate to buy in this country. They want the access to technology and brands, and again, they want to bring capital over here. It's hard for them to get deals done. They have a language barrier. They have a culture of not having traveled outside China very much in the past, and the leaders of many Chinese companies don't have MBAs, don't have traditional financial training. So it's a very, very challenging to get a deal done of that type, and frankly, on the other hand, Western bankers in this market don't want to waste time on a deal pursuing a Chinese buyer if the chances are the Chinese buyer will never get to the finish line. So I think there's a job for all of us in this room to help educate Chinese buyers who really have a lot to offer, particularly capital in this market. But those Chinese buyers have to pay a premium at the moment to get a deal done here.
Another thing is that you start earlier in dealing with foreign buyers in a process. It takes much longer to negotiate a confidentiality agreement. it takes longer to get the people to participate in the process. They are accustomed to run processes. A lot of the transactions they've done are really transactions which are, among friends and family or with the governmental support. To have an open auctions or a process is something that you have to teach people how to do. Particularly true for Asian, not necessarily just Chinese, but in general. So whenever you deal with that, the importance of advisors, lawyers, accountant professionals becomes paramount. The ability to have local reach, like our firms have in Beijing or in other parts of Asia, makes it very, very important to be able to talk to these people, explain it, and maybe run parallel processes where you start early with them, and then you try to bring them at the same conclusion, time-wise, as you are with other people.
And I would add at our firm, just to put some data around it, we've sold 54 transactions year to date, 8 of those to foreign buyers, and which is over 10%, which is higher than our past experience. But interestingly, 7 of those, the foreign companies, have significant holdings in North America already. And so for our firm, that's where we're focused, for many reasons. Culture, time, similar legals, all of the above.
I might comment a little bit on the different geography with respect to a little bit on Middle East and Africa. We've been spending a bit of time there over the last couple of years. We've got over 1,200 manufacturing jobs in Africa currently, and we're finalists on 5,000 more right now in the Northern Africa Middle East region. And in those areas, you guys probably experienced, you can't briefcase bank there. You just can't zip in. You've got to really develop relationships. You've got to have tea. You've got to be trusted, develop a friendship. And whether the deal happens in the sort of current quarter is not as important. It's more developing the trust and relation. And the interesting thing is, some of the, I guess some of you all, the interesting thing is that
I wasn't disagreeing.
some of probably your, Rene, and significant clients or voting interests are these equity funds that are in fact funded as by limited partners from these regions.
Right.
I have to say, one reason I'm in this business is not, to have gray hair, although that was a consequence, is that there is less competition when you're ready to do cross-border deals. I mean, the whole of Wall Street is in cookie-cutter deals, right? Domestic deals. We are in a complicated area. I've been in this for 35 years. I still go to Europe every month, and nothing, as Robert just was saying, nothing replaces the contact, face-to-face and the eye-to-eye and so on and so forth. And especially when you have to explain the processes that Federico was talking about, and you have to bring people to the realization of how to win here.
Bakers say that true foreign buyers have sticker shock when it comes to fees. I'm sure you have to navigate that one as well.
They do. Especially from lawyers, right?
Well, there's things called incentive comp and success fees and other ways of on the client side that you're able to structure. But a lot of this comes in relationship. If they think that they're going to see a positive return from their time and there's more leverage towards things from professional firms like ours.
One of the ironies is the US is the most competitive market for investment banking in the world. Many people might argue there are too many bankers around, but the fees are generally higher in this market than in most other markets. And I think Europeans are beginning to get more comfortable paying fees, but certainly in some of the emerging markets where we work, in India and China, as Federico mentioned, people are used to using a trusted uncle or a friend of the family as their advisor. And the idea when you're going and spending a lot of money to buy a company, to spend even more money beyond that to pay a bunch of overpaid professionals, that is not very appealing to
On the other
Asian.
hand, it allows us to screen among the people who are serious about acquisitions. And by asking them to pay a retainer or to at least be formally engaged, this is a way that you dignify a little bit the role of the advisor, and you allow to really separate the people who do it example, and the people who really are serious about it.
I wonder, do you think that activist investment, which is driving a lot of M&A here, will become a foreign export? And if so, where?
Maybe this is something we talked a little bit about. And by the way, I didn't see the memo of any of these questions, so this is pretty good. But with regards to Smithfield Foods, that was something that I knew you guys were retained on by the activists as well as I think Moelis. But that's something that was in my region in Virginia, and I think what at the end of the day the announced price by the Chinese was it a little bit just north of 8 times EBITDA, which wasn't terribly high. And the further you get into it, I guess you all were retained by Starboard and the chance to meet with them, and I think their thesis turned out to be correct, because in the Hillshire Foods, I think transaction, the multiple was way in excess of
16
this.
times.
Yeah. So, but as you got further into it, I attended the Senate Agriculture meeting with Chairwoman Stabenow from Michigan and all. And just in that presentation, when they mentioned, for instance, Goldman Sachs had a 5% stake in the Chinese and what have you, they clearly had done their homework. They had CFIUS, a proactive CFIUS approach and blessing. But that was an interesting thing where you had a strategic, but then you had a U.S. activist saying, "Hey, let's slow down for a moment," and then they got you all involved.
If you believe in capitalism, you believe in the right for people to make decisions about how they invest money, and you believe, I think, in the need for companies to run themselves, particularly public companies, to be well run. And I would take a pretty hard-nosed capitalist approach on this, and I would say that activist investing is one of the best things that the U.S. has invented, and I think it generally brings discipline to the market. A good way of kicking out boards of directors who haven't performed well. There has been some export of activism. Several funds tried to operate in Japan, which is in dire need of activist investing, and they were very, very roundly rebuffed. It was seen as an absolutely abysmal Americanism in the Japanese market, and they all closed down simply because the market wouldn't allow them to participate there. But I suppose Europe could do a bit of activist investing too.
On the other hand, it depends on the number of public companies to begin with. When you have, in Europe, there are far fewer public companies in some large economies like Germany or Italy compared to, say, the UK or the US. So activism is something that was present many, many years ago. They were in Switzerland, Tetalanti, Weiser Pratt in the UK. Other people have been there for 20 years. But there aren't too many targets in a public sense. Now they're beginning to be much more active. But
Is that because they're seeing the returns?
well, there are definitely returns. There are definitely inefficiencies. It's very clear that some of the activists are pushing for very logical things, that complicated Chinese box structures in Europe, ownership and family investments that did not really allow for that.
Well, I think it has to be socially acceptable, and that's the issue. And I think those activists who have been successful in Europe have been successful because somehow they managed to turn their arguments into arguments which were favorable either to the society as a whole, to the workers, to the environment, or they turned them against the fat cats in a way which resonates in several of the socialistic countries of Europe. So they have to find that bias. Being an activist just to make money for yourself doesn't work.
So for the last question, then we'll open it up to the crowd. Private equity, do you think it is becoming less localized, more global? What's your take on the current state of private equity?
I'm quite impressed with how globalized private equity is becoming. And it used to be a fairly localized business. The teams are younger and younger and more willing to travel, and to travel far and wide. I think also it's becoming a real industry. It was a cottage industry, and now it's a major part of the financial system. And we see private equity buyers and sellers with officers, I think, as Federico mentioned earlier, in many countries, including now in Africa. I mean, places that, you know, I remember when people didn't have a passport in private equity firms in New York, right? It's changed.
I would say we are seeing, you know, half of our private equity deals are cross-border deals. They're really, or roughly half. I mean, they're really out there. You know, I think it's like anything else. If you're chasing a good deal, you're going to chase a good deal if you have the funds to deploy. And you know, a lot of the funds are set up offshore funds just for the purpose of doing offshore deals, as well as onshore funds to do the onshore deals. You see more of that.
Yeah, I think from an asset class perspective, I mean, we operate more as a family office in true private equity there. We're not a GP managing LP interests. But on the LP side, there is a specific mandate and interest by these GPs to stay with what their desires are. And if it's to diversify the sector and revenue streams and hedges, they're moving that direction. And if they don't, someone else will. So I think that's why you're seeing some of these multi-product from some of the particularly the larger ones.
Great. Any questions from the audience?
Can you people comment on the economic circumstances, say in Japan and Europe, where in Japan you basically have recession with all the money being thrown at the problem. You have Europe, comparable situation, and throwing money at the problem there is quite similar to throwing at the money at the problem here, where without fiscal policy, monetary policy doesn't have the same effect. How does that affect your M&A transactions, the companies you look for? What are the characteristics that either make you do something go forward or not?
Japan has a particular challenge. Actually, it has a bunch of particular challenges. Aging demographic, persistent long, effectively, we always used to joke, wondering whether we're coming to the end of a 20-year recession in Japan or maybe halfway through a 40-year recession. It's actually a great opportunity, I'm afraid, for us. Again, instability creates opportunities in our business. And I'm astounded, even though the yen is very weak at the moment, Japanese companies are going to be very aggressive over the next year. They're talking to us, asking us, how can we do anything to invest outside Japan? So that's a wonderful opportunity, again, for everybody in this room. And the bankers would be wise to take it pretty seriously, even though we think it's often difficult to do business with Japanese companies. They move slowly. It's hard to understand really what their intentions are. They're going to continue to close a lot of deals.
Yeah, I would add, if I may, in April we sold a client company, WB Johnston Grain, to a Zeno and a Tochu held subsidiary called CGB. It was a $100 million plus transaction. And the folks at CGB told us that this was part of a 50-year plan where securing additional food sourcing of grain, wheat, corn, milo, frac sand even, these basic commodities, was on par with national defense for their firm. And so, from a strategic viewpoint, they were willing to pay a premium in order to get long-term relationships that my client had in the U.S.
I think we're out of time, but we'll all stick around after if anyone has any other questions. Thanks for joining us.
Thank you.